Hey everyone, my name is Jeff and I'm the head of marketing at A2X, e-commerce accounting automation software for the world's leading Shopify, Amazon, eBay, Etsy, and Walmart sellers, as well as their accounting partners. And speaking of accounting partners, I'm joined today by Simon and Carl from SBO Financial. SBO Financial is a full-service accounting practice based out of Australia. They specialize in working with fast-scaling e-commerce businesses, and we're so lucky to have them here today to share their expertise with us. Simon and Carl, thank you so much for joining us here today. I hope I did my description of SBO Financial justice, but if I might have missed anything, or if you want to talk about the type of businesses you work with, now's your time to shine.
Thanks, Jeff. Appreciate the invite and good to be here. We're a remote first asynchronous accounting firm based in Australia, as you said. We've been around we've just ticked over 10 years now. But with e-commerce businesses anywhere from 1 mil to 10 mil in revenue, sometimes upwards of that, offering the full suite of accounting services.
If you are looking for accounting services for your Shopify store, the SBO Financial team is an amazing option. We'll put a link in the description below in terms of how you can reach out to them, and we'll take it from there. All right, so let's get right into it. In this video, we're going to talk about building the perfect profit and loss statement, otherwise known as P&L, for scaling Shopify merchants. We're going to cover what a great P&L looks like, how to get accurate data into your P&L, and then how to read your P&L and generate insights so that you can make informed decisions. Carl, so I'm going to start with you. To help frame this discussion, let's level set, because I know we might have some newer Shopify merchants watching the video. What is the definition of a great P&L, and why is it so important for scaling Shopify merchants?
So a P&L is where you find out how much money you've made in a period of time, whether it's a month, a year, or a quarter. It's very important. It's probably the key financial statement business owners will look at, because everyone wants to know how much sales they made and how much profit they made as well. But a great P&L can tell you so much more than that. It'll tell you your gross profit. It'll tell you how efficient you're selling your products, and it'll give you insight into how your ads are performing as well, and how your business is performing and generating profit. You can get a lot of insights out of a P&L if you structure it properly.
Nice. I love that. In a recent discussion with another A2X partner, they said that the P&L was the scorecard for how your business is doing on a monthly basis, which I thought was quite apt and a good addition to your description.
Yeah, it is very much a scorecard. It tells you how you performed, and the numbers don't lie if you get accurate data in there.
So when we talk about a great P&L, or even just an accurate or easy to read P&L, let's dive into what that actually looks like. Carl, I know that you put together 3 examples for us of a default P&L, a good P&L, and a great P&L. I'd love for you to walk us through it.
Absolutely. So what I've got here is what you'll probably see as the default P&L in your accounting system. It's pretty basic. It doesn't have a lot of useful information in there, apart from just seeing your total sales, a bit of cost of goods sold, and operating expenses, and then your net profit at the end. Not really something you get a lot of great insight for, and not really something tailored to an e-commerce site either. So what I put together this one, which I'd call a good P&L, and I expect every e-commerce site to have something similar to this. In here we have more detail on your trading income, so breaking out your sales revenue, discounts, and returns. Cost of goods sold, getting your merchant fees and outbound freight up there instead of in OpEx. Showing some gross profit margin, and also categorizing your customer acquisition costs in their own little section here. And then you still have your other OpEx, and net profit is still the same. And then a great P&L is where you can go even deeper with the help of A2X, and you get category or geography-based trading income and cost of sales. We have some other custom metrics in here, like contribution margin, showing more detail and giving you more insight to the performance of the business, and still ending up in the same sort of operating and net profits as well.
Very nice. You had mentioned putting together the P&L, and I'd imagine that putting together a P&L, which is effectively the output of accurate monthly bookkeeping, you need to have a chart of accounts that's purpose-built for our Shopify merchants. Simon, do you mind talking to us a little bit about the process of putting together a P&L and what that actually looks like from a monthly and a day-to-day perspective?
Yeah, for sure. So, I mean, the starting point is the chart of accounts themselves. You're breaking out the different revenue components, discounts, returns, all that sort of stuff. But that just defines the layout of the report. The layer beneath that is good bookkeeping and month-end practices. So, for example, it's really common what we say with Shopify merchants. You do your bank coding or whatever once a week or once a month, God forbid. You'll code your revenue straight through to sales. When you purchase inventory, you code it straight to cost of sales and that sort of thing. And just those two behaviors basically renders your P&L useless. If you are measuring your gross profit, for example, and it's doing these ones period to period, it's because of that revenue treatment and that inventory treatment that's causing that condition. The real power of the P&L is being able to draw those comparisons period to period. So if it's like got these big imbalances between the periods, it's very difficult to make decisions from that. So there's a couple of things that we do as part of our weekly bookkeeping. We gross up is the accounting term for revenue. So we split out gross revenue, discounts, returns, gift card sales is another big one, as well as merchant fees, and plug those into the relevant accounts. And then from an inventory perspective, rather than just coding everything to cost of sales, which is the typical behavior, we treat it as an asset, I should say. So we park it on the balance sheet and then move the value of just the inventory that you've sold in that particular period across to cost of sales. What that does is it aligns the revenue from those sales with its associated cost. And what you'll see then in the output, that gross profit line, for example, it should be relatively stable. So as soon if it is accounted for correctly and you're still seeing, sort of ups and downs period to period, well, it's an immediate indicator that there's something wrong. Like we've gone overboard with the sale period and discounted too much, for example. But with that correct bookkeeping practice, you can easily isolate conditions like that.
Nice. And I'm about to shamelessly plug A2X, so forgive me in advance, but you had mentioned that as a practice, you break out the deposits that you get from Amazon into their appropriate categories, right? Like their sales, fees, refunds, gift cards, so on and so forth. Uh, how do you do that, Simon?
It might be a Carl question, but A2X is the kingpin, I guess you call it, that whole process. Automates the accounting for the gift card sales and then redemption. That's a really important distinction, because I mean, if you just take the revenue up from when you sell a gift card, well, you're effectively paying the tax in advance. For example, where it should be sitting on the balance sheet as a liability until it's actually redeemed. And we've seen a couple of horror stories with that sort of thing when it's not accounted for correctly.
Yeah, 100%. And then there's also like the option to do it manually, but manually is incredibly time consuming, error prone, so on and so forth. So there are tools that exist to help automate and accurately automate some of the process. A2X is an example, as you just mentioned. But I think kind of the TLDR from everything that you just described, though, is ensuring that you're appropriately categorizing every transaction, right? So that you can actually have a P&L that provides value. And Carl, I think this is a great segue into, potentially, I'd like for you to dig into what a P&L that provides value looks like, your great P&L example. And do you mind talking to us about why a Shopify merchant would get additional value from a great P&L comparatively to a good or a default one?
Absolutely. So focusing on the great P&L I've got here, lots of detail in here to give lots of information. So as Simon mentioned, if you've got everything accurate and all the bookkeeping done properly, you should have consistent gross profit margins. But as we can see here, in November, it dips down a bit, about 5% in November in this example. And if we just had the default P&L on the same data in all these three P&Ls, like you're not going to be able to figure out, well, you don't even know your gross profit's gone down because it's not there. So this is useless.
Yeah.
Then if we get just the basic P&L, I think every e-commerce should have, you can see that your gross margin's gone down. And if we look up, we could identify why, and that's your discounts. So you've heavily discounted in November, which is probably going to be Black Friday sales, as everyone does. Returns have gone up a little bit as well, but your sales have also gone up a lot there. But you could really see it's just your discounts have gone up disproportionately to your sales in the month, and that's hurting your gross profit margin. But with the great P&L, when you sort of separate things out by category as well, and this could be like category here, we've got like golf clubs, balls, and accessories, or it could be geographies like Canada, Australia, and USA, or any which way you want it. But in this example, we can see the accessories for the month, discounts haven't gone up massively compared to sales, but we've really discounted golf balls and golf clubs in the month. And that's really what's hurt your gross profit margin. But in the great P&L as well, I've also separated out a contribution margin. So that's really your profit after factoring in your costs to acquire customers, so customer acquisition costs, which your advertising and some marketing agencies and stuff like that, which is a key metric for a well-performing e-commerce store. We can see here that the contribution margin is actually pretty good for the month still. So that tells us that while we have sacrificed some gross profit margin for the month, we've done it efficiently with our ad spend. So we haven't had to spend heaps of money to acquire the customers to generate those sales. What we've given away in discounts, we've sort of saved a bit in sort of advertising costs as well. So we've still ended up with quite a healthy increase in our contribution margin. It's gone up sort of over doubled from October to November. And we can see here our total sales have gone up massively as well. And we've sort of transferred that into some nice operating as well. So those are the extra insights you can get from a good laid out, detailed profit and loss with all the underlying accounting treatment done well, of which A2X is a sort of critical component to getting all of these sales and cost of goods sold spread out into the appropriate accounts. Because doing this manually is not fun and takes a lot of time.
I love this example because so often Shopify merchants look at bookkeeping as a means to an end for compliance, for tax, right? But the P&L as an output, specifically the great P&L, gives you insights to make informed business decisions. And business decisions as a concept is so fluffy, right? Like people are like, oh yeah, go have good numbers, make good business decisions. But what you're showing here clearly is that the numbers are actually allowing you to think about what products are actually profitable and driving revenue, right? Is my discounting strategy right? Or am I over discounting? Am I under or am I over recovering on shipping, right? Is my marketing cost too high for a particular category of products or a region? Like this gives you the level of insight that you can actually take action against to run a more profitable business. I know that I'm ranting a little bit here, but I really like it's very visual, and you've been able to help visualize the amount of value that you can get from accurate bookkeeping. Carl and Simon, I guess my next question here is, okay, so now I've got this great output. How often should I be reviewing it? And as expert accounting partners, how often are you going over this with your clients?
Yeah, so you should be reviewing your P&L at least every month. And that way you sort of it's a good cadence to capture the performance. Anything less than that, and you're not going to be able to capture all the expenses properly because things like rent only happen once a month. So all your OPEX is going to be a bit inaccurate during a month. But yeah, once a month is the appropriate time to review a P&L. And you'd also compare it to like budgets or forecasts you've done as well to really generate heaps of value out of your reporting and your account.
Awesome. So once monthly as a Shopify merchant, and then the next question is, you work with tons of Shopify merchants. How often do you go over this with your clients, and what additional level of insights can you provide? Simon, I'll ask this question to you.
Yeah, thanks, Jeff. Monthly is the typical cadence. We're mindful that founders are critically time poor, right? So the last thing we want to be doing is burdening them, either with information or time, right? There is such a thing as information overload. So monthly is a really good cadence. What that looks like depends on the nature of the engagement. You can get a wealth of information just from the reports in Xero, but as Shopify merchants will know, there's a boatload of other metrics that you can tease out by combining Shopify and financial data from Xero or whatever accounting system that you're using, and that's the sort of thing that we'll do in an advisory engagement. So it's typically a reporting pack with at least a monthly catch up to go through the numbers and tease out some actionable insights.
So given that the SBO Financial team puts together these great P&Ls on a regular basis, you go over them with your clients monthly, I'm positive that you have some pretty amazing stories of how these reports have been particularly helpful for some of your clients. Can you think of any at the top of your head that you'd like to share?
Yeah, I can actually. We had a client, a relatively new client at one point. We went through their P&L and sort of something didn't seem right, and we scratched that itch a bit. We found out that they were recognizing gift card sales as income when they were, which is not the correct accounting treatment. And as we dove in further, we found out that they had a gift card liability balance of about $300,000 that was incorrectly accounted for in the P&L, that it should have been in the balance sheet. Now, what that meant for this company was that they were paying income tax on money or income that they hadn't earned yet. And it was Australian business, so there was a GST as well that they were paying on that we got to claw back for them. So that was to the tune of about $30,000 we got back to them overnight, just by looking at and having great accurate reporting in their P&L for the month and doing it properly. So yeah, there's some real tangible insights you can have from having accurate data and reviewing these reports monthly.
And massive cash flow implications, like what you just described, would cause a cash flow crunch. I would imagine revenue that isn't actually realized that you have to pay tax on is insane. 300,000 specifically. Yeah, that's crazy.
Yeah, might add, Jeff. What I hear from founders all the time is they don't necessarily engage with their numbers because they don't trust what's in there. Obviously, Shopify is the gospel from a sales perspective, but depending on how they've been doing the bookkeeping, there'll be this mismatch between Shopify and the accounting system, and as soon as they lose trust with the numbers, that gets pushed to the side. They don't engage with them, or they're trying to cobble stuff together in spreadsheets or using other third-party plugins or something like that to try and get some transparency of their financial position. It all starts with just good basic bookkeeping practices, reliable data going in to get good reports out, and then we get the trust back. We can make data-driven decisions off the back of that, and it's just a whole lot more comfortable place to be than sort of sticking a finger in the breeze to see which way the wind's blowing, which is a pretty uncomfortable spot.
100%. And you could get to reliable bookkeeping in a multitude of ways. You could do it yourself, right? The only risk there is, Carl had a really great example with the gift card example that you might not know what the right accounting treatment is, but assuming you do, you could do it yourself. But I would imagine that if you're a Shopify merchant, you didn't get into business to do your own bookkeeping. But another way is that you could work with a team like the SBO Financial team. And then, that's supplemented by tools like A2X that pulls in the data, summarizes it, and then posts it to Xero. And then you could match from, say Shopify, A2X, and Xero to make sure that the data lines up and that you trust it, to your point, Simon. And then, you trust it so much so that you could actually take advantage of it, make smart decisions with it, so on and so forth. So I think that's a really great point. Trust is an incredibly important component as it relates to your numbers. Carl and Simon, so far, I really appreciate your expertise on this topic. It's been awesome to see what a default good and great P&L looks like, what's included in each, why they're important, some real world examples of how to use the information to make informed decisions, why you need accurate data to be able to trust the numbers so that you actually want to take action against them. You mentioned that contribution margin is a key differentiator between a good and a great P&L. I'd love for you, before we hop off, to kind of go over why you would include it in a great P&L, why it's so important, and how to make sense of it.
Sure. So contribution margin is probably one of the most important metrics a e-commerce business should be looking at. And the reason why is it captures a lot of the costs it takes to make the sale. So looking at a P&L, you have your income up the top, which is the sales you make. You have your cost of sales, which are what it costs for you to make those sales. So that is the physical goods you're selling, the merchant fees, the freight, what it costs for you to get the items to the customer. Then you have your customer acquisition cost, which is what you spend to acquire that customer, to get those people to know you exist and make the purchase. And then the operating expenses are kind of just what it costs to keep the lights on for the business. And they shouldn't move too much, but the contribution margin can move drastically along with the gross profit margin. But the contribution margin captures all of the information above it on the P&L and gets it into one metric that you can really sort of optimize your business for, because it's you can very easily overspend on your advertising to acquire customers and really lose out on margin as a result of that if you're not optimizing for it properly. So it's probably the key metric for an e-commerce business to look at to make sure that optimizing for it and generating the overall profit for a business as well. Once you've sort of optimized for that contribution margin and generated the maximum output from your spending on product and advertising.
Nice. And you can't get to accurate contribution margin without accurate bookkeeping, right? Like you need the input to get to the output first and foremost. Simon, anything that you want to add on contribution margin before we hop off?
No, I think Carl nailed it. The only thing I might add is we love looking at contribution margin because there's so many levers you can pull to improve it. We can increase sales, we can reduce discounts, we can reduce advertising, we can look for efficiencies in advertising, I should say. You might hear us just say kill your ads. That's not a thing at SBO. But that it's the tell-all of your sales and marketing function as a whole. Like there's nowhere for anything to hide. If there's any deficiencies in the sales or marketing function, they're going to be exposed in that contribution margin. So yeah, it's the tell-all for how healthy your sales and marketing function is as a whole.
Fantastic. Well, Simon and Carl, I've learned a lot through the course of this video. I really appreciate you joining us here today and sharing your expertise. If you want a great P&L and a team to help you get to it, and then obviously the insights that come from the expert support from folks that are doing this across multiple Shopify merchants, I highly recommend reaching out to the SBO Financial team. Their link is in the description below. Otherwise, Simon and Carl, thanks again, and we'll see you soon.
Thanks, Jeff.
Thank you for having us, Jeff.